Welcome back to, I don't know how often this is going to happen. We're going to try and make this a more regular thing, but we used to do a lot of videos, I used to do a lot of videos with guests, and I'm going to try and bring that back now that the market is settling a little bit and make it a little bit easier for you as consumers to understand what's happening here locally in comparison to the national news. Today, I have Adam Karcz with NEXA Mortgage and Derek Hoff with Hoff Private Investors. Is that right?
Off private wealth.
Wealth. Sorry. Hoff Private Wealth. They are an investment firm here in Wausau. Both of you are here as experts today to help us understand the interest rates. Our market has shifted clearly. So from the real estate perspective, I know what's going on. From the mortgage perspective, Adam knows what's going on. And from the investment standpoint, Derek knows what's going on. And this is a pretty damn great panel of people, top-notch, stellar professionals. These are my dream team guys that I go to with my financial needs. They have guided me very well. So when I ask them questions, I trust them wholeheartedly with my own money, which is why I've asked them here today. Welcome, gentlemen.
Thanks for having me.
You're welcome. Thanks for the exciting morning. Okay, so let's get right into it because we don't want to keep people on the hook for too long. Rates went up. We all know this, right? So we've talked about this in the news. It's been highly publicized. It's increased pretty darn dramatically in a very short period of time. So what has that meant on your end? Let's start with you, Adam.
Well, yeah, I mean, they, like you said, they have gone up really over the last, let's look at the year, 2022 as a whole. To start, we were in the threes in January, right? We pushed into the mid sevens, and we might even be settling back down a little bit around seven, even into the sixes again here. But it's definitely what it's meant for the people that are buying houses is that the cost to buy it has gone up pretty significantly on a monthly basis, right? So that's really the biggest
Specifically,
impact.
you're talking about mortgage rates.
Yeah, we're talking about mortgage rates here for sure, not the market rates.
Correct.
I think that's a very good point, Derek. Like, let's define what we're talking about with rates. They're different between the two of you, and they're confusing for the average consumer who doesn't necessarily follow the markets or is only knowing what the news is telling them. So they're hearing the Fed raised rates. That's different for Adam's world and my world versus Derek's world. So, Derek, what does it mean in your world?
First, just a disclaimer: anything that I verbalize today is not to be considered direct advice. You should consult your bankers and your accountants and your financial advisor when it comes to any information that you hear today. This is just speaking general concepts. So ultimately, when you're hearing the Fed hiking rates, you're talking about the Fed funds rate, right? So we're looking at the interest rate at which banks and other institutions, depository institutions, lend money to each other, right? So the banks have to have a certain percentage of their customers' money on reserve, and where the banks earn no interest on it. So consequently, banks try to stay close to the reserve limit as possible without going under it and lending money back and forth to maintain that proper level. And a year ago, at this time, that Fed fund rate was 0.25%. And we had been kind of in this super low interest rate environment for many years. And so this isn't uncommon to be having 5, 6, 7% mortgage rates, and it's not uncommon for the Fed to have to raise their federal funds rate, which a month ago was at 3.25, and as you heard recently, there was another 75 basis point raise, so it's at 4.
Mm-hmm.
And with that Fed fund rate, what people really need to understand, and what Laura and I have been chatting about at breakfast recently, is that just because that Fed fund rate is up and just because mortgage rates are up as well, there's opportunity with your other dollars to offset that. And that's kind of the core piece of what I wanted to chat about today, that there's opportunities out there to capitalize on those Fed fund rates being up, as opposed to looking at as a negative and not purchasing or buying the things you want because of it. And in this specific case, with Laura's industry and with Adam's industry, I think that's a valuable piece of information for the consumer to know.
100%. Agree with that.
Yep. What I love about this is, especially having the three of us in these conversations the most, is that we have very common money and finance ideals, what we want our money to do for us in the long run. So I appreciate the conversations, and I definitely agree that there are a lot of big opportunities here. And I think when we focus on what the news media has broadcast, it always tends to be this big story, and not to, you know, villainize them at all, but it does, you know, bring in ratings to have sort of this, oh my God, the rates are up, the world is ending. When the fact is, an average 50-year, the 50-year average for mortgage rates is 7%. And I've been saying this for a couple of months now, because we've been closing in on 7 for a while now. We're just past 7. We might dip back under, as Adam said, but 7 is very average. When I bought my first house in 2005, my mortgage, we at that point had what was called an 80-20, 80%. It was 100% financing, but you had a first mortgage for 80% of the loan amount, or the purchase amount, and 20% of the purchase amount was a second mortgage or a line of credit, one of the two. So I had an 8.25 on my first mortgage and a 13 something on my second, which, you know, if you average those together, you're in the like 12.5 range or 11.5 range, something like that. That's what I paid for my first mortgage in 2005. So we are certainly nowhere near where we were. Obviously, 2005 was prior to the crash. That's clear, but we certainly are nowhere near where we were just a very short period ago.
Yeah, and I mean, I like Derek's point. You know, bringing back the fact that there's going to be opportunity, and there is opportunity to have your money working for you now. And when we look at the inflation side of things, the biggest hedge against inflation, or one of the bigger hedges against inflation, is a fixed payment, right? Yep. So having a fixed mortgage payment, either whether you're in it currently from a past purchase, or you're going into it here in the future, like that's a really good hedge against future inflation, is having that fixed payment in your budget. So that's one thing I really like to make sure people understand.
Yeah, we have seen a lot of people sort of going into those 5-year, or I think I saw a 3-year and a 7-year as well, ARM product, which is an adjustable rate mortgage. If you've not, you know, heard of those before, which, let's talk about, what does that mean? What is an adjustable rate mortgage?
Well, what it is it's your interest rate is fixed for that first period of time. So if it's for example, a 3-1 ARM or a 7-1 ARM, if you're in a 3-1 ARM, that interest rate is fixed for the first 3 years, and then it can adjust once a year after that, every year. So that's where the 1 comes in, and with the 7, it's fixed for 7 years, and then it can adjust once a year based off of whether it's the specific index that company is using for their adjustments, whether it's the LIBOR or the things like that. So that's really what an adjustable rate mortgage is. And why you're seeing them being used right now is because they're typically a little bit better in the interest rate side of things up front in that fixed period. And there's a lot of people that are telling us that we're going to see rates come back down from the mortgage side of things, the mortgage interest rates, that will give them an opportunity to either refinance into something longer term in that time frame, or they're just comfortable taking that risk of that adjustment in that 3 to 7 years down the road.
I have been hearing or seeing a lot of people who are not intending to stay in the property that they're purchasing with that ARM loan for a longer duration than 3 or 5 years. So in that case, it does make sense. If it's something that you were intending to be in long term, that could potentially not be a great option unless you did have the opportunity to refinance. So I think those are things that people don't realize there may be options. I think 30-year mortgages, 100% financing has been used for such a long time now. We're certainly well established in the realm where, especially first-time home buyers, just assume that that is, one of the only products out there, and it certainly is not the case. We definitely have a ton of options for people with lower rates than a 30-year fixed mortgage. So Derek, let's talk a little bit about how to make our money work for us in this scenario. What are those opportunities? Let's talk like we're talking to kindergartners because I think that there's a lot of confusion. I know that before I really started working with you, and I told you from the get-go that the interest rates and the investment world to me was like complete Greek language. I didn't understand it. I do now, thanks to you, but I think that it's important for people to understand on a fundamental level what this is about.
Yeah, I'll just start with the basics of why I guess there's relevance in my job. One, if you stuff your money in your mattress, for example, you put $100 bill under your mattress with current inflation where it's at, that same $100 from a purchasing power standpoint, 12 months from now is now, 85 or 90 bucks instead, right? And if you think about your earnings for a year or over the course of a career, if you don't save and invest and buy appreciating assets, you put yourself behind the 8 ball for when you do need to spend down the road. So investing or getting your money to work with you and for you in some way, shape, or form is key, and that's why our job is relevant. And looking at specific to a mortgage for sake of this conversation, Adam, what's a standard 30 right now?
Just under 7.
Yeah, so let's call it 7%. So an example of what people can be doing to offset that 7% is, let's just say, for sake of round numbers, we're talking about $1,000 a month mortgage. Okay, take taxes out of it, take the other pieces out of it. We're just talking about $1,000 a month mortgage. So you're looking at someone's going to have to spend $12,000 that year with 7% interest on those dollars, right, spread out over the life of that contract. And people are freaking out about it. And in our world, we're not a huge fan of taking on debts above the 4% threshold. Ideally, we like to stay under that. 5 is okay. But just in this example, let's say $12,000 for that year went towards your mortgage. You could right now take an additional $12,000 and looking at bank rates for today, you could stuff it in the money market and get 1.5% in a money market. Well, now we're talking about a 5.5% instead of 7. Or you could take a step further and put it into a CD and have it locked up for 12, 24, 36 months. And you could get potentially 3.5% out of something like that. Or you could simply buy an ETF of short-term treasuries right now. And the interest rate on a 1 to 3 year short-term treasury is between 4 and 4.4%, depending on what you get locked in. So if you look at something like that, if I took an extra 12 grand and put it into a short-term treasury for the year and I get back 4.4%, my interest rate on my mortgage of 7 doesn't look so terrible anymore. In fact, that looks pretty darn good. In my world, for anybody who's 20, 30, 40, 50 years old, I think you should be looking at utilizing your tax leveraged accounts, meaning your 401ks or your Roth IRAs first. But I think that where the stock market is at and how beat up the bond market got, that there's so much opportunity to be an investor right now that 4.5% return on short-term treasuries seems great in concept, but you're probably in a situation where we're looking at 10, 20, 30, 40% gains, depending on how aggressive you are in the market over the next couple of years. So people who don't like risk, get your mortgage at 7% and throw your excess into short-term treasuries. You can talk to your advisor about it. A lot of banks will help do that as well. Some people don't understand that, so they like to invest in things they understand. Utilize CDs with your bank to offset that, or utilize your money market if you like the least amount of risk possible.
It's so interesting because we haven't had CDs or even savings accounts really have much return, gosh, in over a decade. It's interesting to see that come back as an option. I remember as a kid getting bonds for Christmas or birthday gifts.
Yeah, and to Derek's point, I mean, honestly, with the way things are right now, there hasn't been a better time in the last decade to enter the market than it is.
What
currently.
market? You got to be clear on what market you're talking about.
Getting into the stock market, I truly believe, I agree with you that there's a ton of opportunity there.
Yeah, I do agree too. And the reason I brought that into the mix of real estate and mortgages is because there's such an undercurrent of anxiety that comes with, oh my God, the rates are up, but it doesn't mean that you're, out of opportunity for your money to work for you. We know over the course of 100 years at least, that real estate will always increase, but if that's your immediate investment, it might not return for you right now. So that's where the money market and the stock market comes into play, and having an actual strategy for your money, not just a place to live or a place to put your funds in a bank account. I do want to kind of just address the market here locally a little bit. We have seen, and we're heading into winter, so let's be fair, we always have a little bit of a decline going into the colder months. That's very normal for us. But we have seen longer times on market. We have seen definitely some price reductions happening across the board. We have seen many offers be accepted under ask price. There are, to be fair, still competing offers. Just wrote one yesterday, going in above asking on certain properties, because we do have pockets of desert where there are no homes available, especially under the 150 mark in Lincoln and Marathon counties and north, even and south. So my forecast, as far as where are we headed in the next 3-6 months, if you're thinking about buying right now, I think you definitely have some opportunity. You have a lot more opportunity than you did 3 months ago, even, to get into a home. Even though your interest rates is going to be a little bit higher than 3-6 months ago, you're at least going to have a chance to get into a property. And I think that that's a very big change from where we have been the past 3 years. It's been a very stressful market for buyers. If you are a seller, prices are staying fairly stable. You're not necessarily going to get more than you're anticipating. And if you're pricing your property too high right now, you are certainly hurting yourself. So finding that target price, which is honestly a nightmare as a realtor and appraiser, to try and figure out where it's going to go in the next 30 days compared to where it has been in the past 30 days is very, very tricky. Because buyers' temperatures right now are a little all over the place. We cannot necessarily anticipate that going into December, there's going to be as much buyer activity, or that they're going to want to pay a 7% interest rate. Some people might just choose to wait until spring. It's hard to say. So I think from the perspective of real estate, it's important to work with somebody in your local market, and each little burb around the Wausau, Merrill, Marathon, Stevens Point area has its own very unique set of circumstances. So just a blanket statement Wausau or blanket statement Merrill doesn't really accommodate everybody's needs, especially if it's rural versus urban real estate. Those are very different markets right now. So that's my perspective from the real estate standpoint. Any last words, Adam?
Well, I just kind of want to reiterate with what you said. Like there's opportunity in this right now. There's a lot of people that have been looking for a house for several years and have had a very hard time, because whether or not they need a specific loan program, whether or not they just didn't want to overpay for a place, whatever it may be at the time. Like there's opportunity for those people to re-enter the market, and get into a home here coming down the stretch. And there's going to be opportunity as we go into the spring market for sure for that to happen. So yeah, definitely reiterate that there's opportunity for people that have had some trouble over the last couple of years getting into a house, to really enter back into that mix.
Great. Any last words from you, Derek?
Yeah, a couple things. One, Adam, you probably have some statistics on this, but I got to believe that the average person, doesn't fully live out that 30-year, they don't pay that same loan for 30 years, right? There's going to be opportunities 5, 10, 15 years from now to, refinance. And these rates aren't terrible. Go back and look in the 70s and 80s, right? And also, I do think that from Laura's perspective, what she's mentioning about, prices in general haven't like fallen, but there's pockets and there's opportunities to be had. And for any of you Facebook marketplace people, the kind of the process of inflation increasing and people feeling it at the gas pump and feeling it at the grocery store and struggling with it, you're seeing campers and cars and UTVs and snowmobiles listed all over the place. The next step is going to be land, and then you're going to start seeing people consider that prices are still decent, and there's going to be more properties for sale too. And it will be, a little bit of a discount from what we saw end of 20, beginning of 21. I think there's opportunity, and I don't think the interest rate should deter people. A lot of the conversations I have with people are around planning, and you look at right now, let's say there's people in their 20s or 30s looking for their first home, or people in their 30s and 40s, 50s looking for their cottage or their forever home. Time is limited, time is limited. And if you're going to wait just for interest rates, I think you're going to get 3 to 4 more hikes. I think the economy is going to tank for the next 6 to 9 months intentionally by those rate hikes. That's what they're doing intentionally to get inflation under control. You could be waiting 2, 3, 4 years to get rates back in the 4 or 5% range, if not longer. Life is short. Find a way to make your money work for you and fulfill, the dream of being a new homeowner, or the dream of buying your cottage, or the dream of getting your forever home. And talk to your advisors to figure out how to make it happen for you.
Great advice.
Well
Sorry, I had a little window peeper waving at me. So
well said.
Definitely want to thank you both for being with me today. I really appreciate your time, and I definitely appreciate your knowledge, being able to trust having these conversations with you. So thank you. I'm sure we'll talk again about some strategy in the very near future. And have a great day.
You too.
Thank you.
Be kind.